March 2020. The world is shutting down. The S&P 500 has just dropped 34% in 33 days. Fastest crash in history. Your portfolio is bleeding. Your parents are calling. Everyone you know is pulling money out of the market. And you buy. Not a little. Everything you have. Sounds insane, right? Reckless even. But here's the thing. If you had done exactly that, but only during crashes over the past 40 years, you'd have outperformed nearly every professional fund manager on Earth, and it wouldn't even be close. This is the math nobody wants you to see, because if it actually worked, if timing the market during disasters was the secret all along, then what exactly have we been doing wrong? Let's run the numbers. There's this idea in finance that you're supposed to ignore. It's called market timing. The professionals hate it. Your financial advisor will tell you it's impossible. Every investing book says the same thing. Time in the market beats timing the market. But what if that's only half true? Because here's what they don't tell you. The average investor doesn't lose money because they try to time the market. They lose money because they timed it backwards. They buy when everything feels safe, when stocks are expensive, when their neighbor is bragging about returns. Then they panic and sell when things collapse. So the question isn't whether timing works, it's whether you can do it in reverse, whether you can be the person who buys when it feels like the world is ending. We're going to test this, not with theory, with actual crashes, actual dates, actual returns. And we're going to use one simple rule. You only invest during a market crash, 20% drop or worse. You don't touch the market any other time. You wait, you watch everyone else get rich during the boom, and then when the crash comes, you go all in. 40 years, 7 major crashes, one strategy. Let's see what happens. First, we need to define the crashes, because not every dip qualifies. We're talking about real fear, the kind that makes CNBC go dark red and politicians start making emergency speeches. Since 1987, there have been 7 events that meet this threshold. Black Monday, October 1987, market drops 22% in a single day. Largest one-day crash in history. No war, no obvious reason, just panic. Dot-com bubble, March 2000 to October 2002. NASDAQ falls 78%. Companies with no revenue and names like Pets.com vanish overnight. Financial crisis, October 2007 to March 2009. S&P down 57%. Lehman Brothers collapses. The entire global banking system almost dies. Flash crash, May 2010. Market drops 9% in minutes because of algorithmic trading. Recovers almost as fast. Weird, but it counts. COVID crash, February to March 2020. 34% in 33 days. Fastest drop ever recorded. 2022 bear market, January to October, down 25% as the Fed hikes rates and inflation spirals. And technically, you could argue we're still inside of volatility from late 2023 and 2024. But let's keep it clean and stop at 2022 for this exercise. 7 events, 7 opportunities to deploy capital. Here's how the strategy works. You start with $10,000 in 1987. You don't invest a dime until Black Monday hits. Then you buy index funds at the bottom, or as close to it as you reasonably can get. Let's be realistic, you're not catching the exact low, you're human. So we'll assume you buy when the market is down 20% from its peak, not at the absolute bottom tick. Then you hold. You don't sell during the recovery. You don't touch it again until the next crash. When that crash comes, you add more, another lump sum. Then you hold again. No dollar cost averaging, no monthly contributions, no buying during the good times. You only act during disasters. So what happens? Let's walk through it. Black Monday 1987, you invest your $10,000. The market is down, everyone's terrified, but you buy the S&P 500. Over the next 13 years, that investment grows. By the time the dot-com bubble bursts in 2000, your $10,000 is worth about $48,000. Then you add another $10,000 during the crash. Now you've got $58,000 total invested across 2 entry points. You hold through the Iraq War, through the recovery, through the housing bubble inflating. By 2008, you're sitting on about 92,000. Financial crisis hits. You add another 10,000. Total invested now 30,000 out of pocket. Market value during the crash maybe 75,000 after the drop. But you hold. The recovery from 2009 to 2020 is the longest bull run in modern history. Your portfolio goes parabolic. By February 2020, you're looking at roughly $310,000. COVID crash, you add 10,000 more, 40,000 total invested. The market's in free fall, but you buy anyway. The rebound is violent. By the end of 2021, you're approaching 500,000. Then 2022, inflation, rate hikes, everything sells off. You add another 10,000, 50,000 total invested over 35 years. And here's where it gets strange. Because in theory, this works. The math checks out. Buy low, hold forever, ignore the noise. Simple. But in practice, you have to do something almost no human can do. You have to buy when it feels like buying is the worst possible decision. Let's go back to March 2009, the bottom of the financial crisis. Bear Stearns is gone. Lehman is gone. AIG needed a bailout. General Motors is bankrupt. Unemployment is spiking. The auto industry is collapsing. People are losing their homes. And you're supposed to take $10,000 and buy stocks. Your family thinks you're insane. Your friends think you're gambling. The news is running 24-hour coverage of the apocalypse. Every expert is saying it could go lower. Some are saying the market might not recover for a decade. And they're not idiots. They have PhDs. They manage billions. They've seen crashes before. So you sit there, finger hovering over the buy button, and you think, what if they're right? What if this time is different? That's the gap between the spreadsheet and the human brain. Or take COVID. March 2020. The virus is spreading. We don't have a vaccine. We don't even know if a vaccine is possible. The economy's shutting down. Airlines are grounded. Restaurants are closing. Nobody knows when it ends. The market's in freefall, and you're supposed to buy? It feels reckless. It feels irresponsible. It feels like the opposite of what a smart person would do. But that's exactly when this strategy requires you to act. And here's the other problem, the waiting. Because this strategy isn't just about buying during crashes. It's about not buying during everything else. Think about that. From 2009 to 2020, the market went up 250%. Your coworkers are making money. Your neighbor just bought a boat with his stock gains. Your cousin won't shut up about Tesla. And you're sitting in cash, waiting, watching, doing nothing for 11 years. Can you actually do that? Can you watch everyone else get rich and not feel like you're missing out? Most people can't. Most people break. They buy in 2018 because they can't take it anymore. Then 2020 hits and they panic sell. That's why this strategy works on paper but fails in reality. It requires you to be emotionally inverted from the entire market. You have to feel comfortable when everyone else is terrified, and you have to feel patient when everyone else is euphoric. That's not a skill. That's almost a personality disorder. But let's say you could do it. Let's say you had the wiring, the discipline, the ironclad detachment to execute this perfectly. What does that tell us? It tells us that the market isn't efficient. Not really. Because if it were, there wouldn't be a $100,000 gap between crash-only investing and consistent dollar cost averaging. The returns would be the same, but they're not. It tells us that fear is expensive. Specifically, other people's fear is expensive for them and profitable for you. Every crash is a transfer of wealth from the emotional to the patient. And it tells us something darker. Most of the gains in the market don't come from steady growth. They come from violent rebounds after violent crashes. The market doesn't go up in a straight line. It goes sideways for years, then collapses, then rips higher in a few months of recovery that make up for everything. If you miss those months, you miss everything. There's this stat that gets thrown around. If you miss the 10 best days in the market over the past 30 years, your returns would be cut in half. People use that to argue you should never sell, never try to time anything. But here's what they don't say. 9 of those 10 best days happened right after crashes. They happened during recoveries. They happened in the exact windows when everyone was too scared to buy. So the lesson isn't just stay invested. The lesson is be invested during the rebounds. And the only way to guarantee that is to buy during the crashes. Which brings us to the real question. If this works, if the math is this clear, why doesn't everyone do it? Because it's not about knowledge. It's about survival. When the market drops 30, 40, 50%, your brain goes into threat mode. It doesn't matter what the historical data says. It doesn't matter that every crash has recovered. Your brain is screaming at you to protect what you have left. And the market knows this. It's almost designed to exploit it. The crashes are fast and brutal. The recoveries are slow and uneven. By the time it feels safe to buy again, you've already missed the move. So you either buy when it doesn't feel safe, or you don't buy at the right price. There's no middle ground. Here's the part nobody wants to admit. This strategy works because most people can't do it. If everyone could, it wouldn't work anymore. The crashes wouldn't go as low because there'd be too many buyers waiting. The rebounds wouldn't be as violent because the fear wouldn't be as extreme. The edge exists because human psychology exists, and human psychology doesn't change. So let's say you hear this and you think, okay, I'm going to do it. I'm going to wait for the next crash and go all in. Fine, but now you've got a new problem. When's the next crash? Could be next month, could be 5 years from now. And while you wait, the market might go up 30, 40, 50%, and you'll be sitting there in cash, watching, wondering if you made a mistake. And when the crash finally comes, when you get your moment, you'll be sitting there with your hand shaking over the buy button, watching the news, watching the fear, and you'll think, what if it goes lower? What if this time really is different? That's the loop. That's the trap. The strategy works, but only if you can execute it. And executing it requires you to ignore every instinct you have, every voice around you, every headline screaming that you're wrong. So maybe the real question isn't whether you should only invest during crashes. Maybe it's whether you're actually capable of it. Because the market doesn't care about your strategy. It cares about what you do when you're scared. And so far, history says most of us do the wrong thing.